Welcome to Dollars and Cents. Our podcast is designed to provide listeners with financial advice in a language you can understand. Created and hosted by Marc Freedman, President and CEO at Freedman Financial, he discusses timely topics that help individuals and families make smart financial decisions. Count on lots of energy, candid discussion, and a few laughs. And now, here's your host of Dollars and Cents, Marc Freedman of Freedman Financial.
Welcome back to another edition of Dollars and Cents with Freedman Financial. My name is Marc Freedman.
And I'm Marion Gilman.
And we're here to provide you with some financial advice in a language you can understand. You know, the past couple of weeks, the stock market has kind of leveled off a little bit. We saw a nice run at the beginning of this year, of course, and who knows what the future will hold.
We saw a little pullback as well
we did.
A couple months ago, but now it's looking good.
It has, but we've seen a lot of clients over the past few weeks, and there's been this recurrence of a question that continue to pop up, and a lot of it is based upon, frankly, what people hear on the news. They get it from a Facebook or some type of a social media post. They hear about it from their friends, and Marion, maybe you could bring our listeners or our viewers up to date on what you're hearing.
Yeah, so we get questions a lot on why have bonds in the portfolio? I mean,
What do you mean? Why should we have bonds?
Why should we have bonds? Why are there bonds? And you should understand that our philosophy at Freedman Financial, our investment philosophy, is that we want to be certain that we, first of all, before we do, create any investment plan for you, we want to be certain that we understand who you are and what your goals and objectives are. That's extremely important. Because how would we know how to invest money if we don't understand what the purpose of that money is going to be, or what the long-term plan is for that money? So, we do that first, and then we set up a portfolio that we think is appropriate for your time horizon and your cash flow needs. And we do use bonds in the portfolio.
Bonds are an important component of a portfolio. It's an income contributor.
Absolutely,
right?
Yes.
And when you think about it, years ago, the old wives' tale. Remember the old wives' tale about stocks and bonds, Marion?
I don't.
What, you don't remember that?
I don't.
All
what
right.
was
Well,
that?
now when I say it, you're going to say, "Oh, I know what you're talking about."
Of course.
There used to be this saying that you put your age in bonds.
Oh, yes,
See,
of course.
I knew
Yes,
know,
I
of
did.
course.
I did know that.
Yes.
Yeah.
So that was what I was.
So if you were 60 years old, you should have 60% of your money in bonds.
And 40% in
stocks.
Right. That was the wives' tale,
Yeah,
right? And as you got older, because everyone had this thinking, well, as I get older, I'm going to unwind myself out of the stock market.
Right.
And move myself into the bond market because I need that security. I need that level of comfort. I don't want to say safety because bonds can move and perform negatively as well, right?
Unfortunately, we all saw that in 2022.
Right. In 2022, there was
2023.
There was the worst performance in the bond market.
Yeah, terrible.
So, and so people are now saying, wait a second. So the bonds lost money. I was only getting a pittance of an interest rate before 21 or 22.
Right.
And now I can go to the bank and get a 5% CD.
Now you can. And I think that is the critical component. So right now you could go to the bank and get a 5% CD. And maybe for the past year you could have done that. Around the past year you could get about a 5% on a CD. A 1-year CD, by the way. These are not long-term
right.
CDs because the banks aren't giving you that kind of interest rate guaranteed for anything longer than a year. However, prior to that, I don't know whether any of you recall, but CD rates, if you got 1% for a 1-year CD, you were doing really, really well.
But everyone has short-term memory, Marion.
That's
right.
right.
They see these signs. I can get 5.1, 5.3
right.
on these, and you know what? Those interest rates are still available at area banks. I mean, we can offer through money market rates, which aren't FDIC insured, but we can offer up those kinds of rates. But how long will they last? Right now, we're looking at bond funds and bond investments as an ever so important part of the portfolio because not only will bonds provide ongoing interest to you, but there's also the potential for appreciation.
That's correct. So the way bond prices work, they work inversely to interest rates. So I know it's counterintuitive for many people, but when interest rates go up, bond prices go down, and when interest rates go down, bond prices go up. So we are looking at a place, we're at a place right now where bond interest rates are high. Interest rates in general are high. And everybody knows that because you can't buy a house because mortgage rates are so high. So bond interest rates are high, and it's likely, according, from what the Federal Reserve has announced, it's likely that they will lower interest rates before they ever raise interest rates again. So going forward, we're looking at a place where it's more likely that interest rates will go down than up. And in that case, bond prices will go up. So not only are you looking at getting a decent, very good return on your bond fund as an interest rate, because the interest rates are comparable to any CD at 5% or more, you will also be in the market and be positioned to take advantage of interest rates going down and prices going up. So you could get a double return on those bonds.
Right, so this is our belief, and I mean there's no guarantees on
That's
anything,
right.
Of course, but we believe that some of the the greatest consistency in a portfolio these days will likely come from your bond allocation. And whether that bond is paying 3%, 4%, 1%, 6%, whatever the rates are, we feel that interest payment that you're going to get will remain consistent, and there may actually be the element of price appreciation along the way. When we say
That's
bond
right. prices
going up, I want to illustrate something that I oftentimes draw it out in a scale. Imagine there's this banker's scale. You've seen it where it kind of weighs on both sides. So imagine you invested $10,000 over here in a bond that's going to pay 4%. Well, 4% on $10,000 is
$400.
good. See, my calculator over here.
There you go.
So, and let's say this bond said we're going to pay you 4% on this $10,000 for 5 years. Now we're in year 2, and someone wants to buy a 5-year bond. And all of a sudden, the interest rates are higher. And so the person says, I want to buy a $10,000 bond, but it's paying 5%. Well, what happens to this bond that we have here? Because they just bought a $10,000 bond that's paying 5%. What happens here? Can you just cash out your bond, get rid of it, and say, well, I'll just get rid of it, take my $10,000 back, and buy a 5% bond?
Well, you can cash it out, but you can't get your $10,000.
That's right. So what happens is you'll still get that 4% bond. If you wanted to cash it out and say, I want my $10,000 back, they're going to go, nah, I don't think that's going to happen.
Right.
Because this $10,000 is going to be worth less.
Right.
Same thing happens when interest rates go down. So if you bought a 5-year $10,000 bond right here, and it's going to pay you 4%, all of a sudden if interest rates go down for new bonds, all of a sudden the one that's paying 4% is much more valuable. People are going to want your bond that's paying 4%. So that's what we mean when we say when interest rates go down, the appreciation and the value of your bond goes up. Now, don't forget that if you hold your bond until maturity, you're going to get the face value of that bond. It will all reset itself.
Absolutely.
But in the interim, you see price fluctuation. And so, Marion, maybe you can help our listeners understand of why when interest rates went up, why that was the impact of 21 and 22.
Right. So what happened when interest rates went up, those bond prices adjusted down, just like in Marc's example. However, once again, if you hold on to those bonds, yes, for that year, you see lower prices. But if you hold on to them, remember, you're still getting your interest payments every month on the bond funds. And if you hold on to them when they mature, you will get the full amount back. I want to go back, though, to one thing that we talked about initially, and that is the allocation of a portfolio when we said you should have your number of years, your age in bonds. So when we look at, are bonds necessary for a portfolio? For a young person, they're not necessary at all, and you probably shouldn't have any bonds in the portfolio if you're 22 and saving for retirement. If you're saving for a house that you're going to buy in a year or two, different story. But you don't want any money in bonds when you're saving for 40 years down the road. As you get closer to retirement, you need to have more security of the portfolio. It pays interest every month. You get those interest payments. No matter what happens to the price up and down, appreciation or depreciation of the actual bond itself, you're getting that income. So bonds help you, get income that you need every month. And that, we feel, is a very important component of a portfolio. They also don't move necessarily in the same way that stocks do. So frequently when stocks are up, bonds might be down, but when stocks are down, bonds either hold their own or they might be up a bit. So
most times. I mean, there's no guarantee, right? No guarantee at all of what will happen.
None. But, when we look at that, it allows people who are living off their portfolio to sleep better at night because they have something that's a little more secure in their portfolios.
But we keep saying bond funds here, Mary, and I think there's a difference between people understanding bond funds and a bond.
Correct.
Because you can lose money. You can lose all your money in a bond, can't you?
You can. Absolutely.
How do you,
as with everything else. So bonds are relatively complex, even though they seem like they should be very simple. But there are different quality bonds. So if you buy a government bond, that's the highest quality because it's backed by the full faith of the U.S. government. So you're pretty much certain that you're going to get your money back. Because
unless the government went out of business.
Unless the government defaults.
That doesn't mean the government shuts down for a month. I mean, the government is out of business.
That's correct. That's correct. So the way you don't get money back from a bond is the company has to go bankrupt or the government has to go bankrupt and default completely. And that doesn't usually happen without really good indicators that that's going to happen, number one. And honestly, I tell people all the time, if if your government bond defaults, we're in bigger trouble than your money. You're not going to be worried about your money. You'll be worried probably about your life.
And so that's one of the reasons why, as we think about being conservative with your financial planning needs and your investment management needs, it's why oftentimes we rely on bond funds.
Correct.
Instead of individual bonds. And why might a bond fund offer some greater flexibility?
So bond funds, the mutual funds, own a portfolio of bonds. So there are probably thousands of bonds within each mutual fund, which means that you can have a diversity of bonds. You can have very high quality ones and you can have lower quality bonds. Remember, lower quality bonds would pay a higher interest rate because they're lower quality. You're taking a little more risk. Higher quality bonds pay lower interest rates. So if you have a nice diverse portfolio, number one, you're not going to be worried about bonds, the portfolio defaulting.
Right.
One bond potentially could default. You're not even going to notice it because it probably represents pennies in your portfolio.
It becomes a non-event.
Exactly,
But,
if you own a fund.
But if you try doing this on your own,
If
how do you decide to pick which bond fund's the right one, Mary?
Well, which individual bond you mean?
No,
Or
if you were sitting at home right now saying, all right, I'm going to start looking at these bond funds, there's thousands to choose from.
Yes.
How do you decide what's the right one?
Well, that's always the question, right? And we have a variety of different screens as to what we look for. I mean, first of all, we look at different quality factors, so we want to be sure that it's appropriate for the client's portfolio. We look at maturities. Are they short-term bonds, medium-term bonds, long-term bonds? And what's our client's time horizon, short, medium, or long-term? So we want to be sure that we match those. We also look at quality, whether it's high quality, medium quality, low quality, and we want to mix it up because most people can afford to have a small amount of lower quality, and it's good to take a small amount of risk for that higher return. So those are the things, and we look at manager tenure, how consistent the manager has been. We look at a whole different a whole variety of factors. And costs, internal expenses of the fund are also a key consideration.
You're all parts
Always.
of it. And we're not usually buying one bond fund. We buy multitudes of bond funds, each which do different things. Same with stock funds as well. That's how we're building out our portfolio, and we're customizing it to you.
Correct.
We build the portfolio that meets what it is that you need both now and in the future, and we weave that concept into everything else in your financial life. We need to know what those sources of income are, whether you're working, whether you're retired, whether you're expecting gifts, whether you have to take a distribution from your IRA, when to collect Social Security, have you applied for Medicare, all of those things. Do you own homes? Do you have rental income? Do you have to pay for your kids' education? All of those factors all build in to how we build a portfolio. And that is what we call financial advice in a language you can understand. So that's going to do it for us today. I want to remind you a few things. If you'd like to learn more about Freedman Financial, if now's the time for you to get serious about your financial planning and investment management needs, we'd love to talk with you. Give us a call, 978-531-8108. We're happy to send you one of our free information kits. That's 978-531-8108. Or if you want to take a look at our information kit online, you want to learn more about us and our entire team, you want to learn about the clients we serve, what we charge, how it all works, or if you just want to simply sign up for our free weekly newsletter. More than 7,000 people get this newsletter each and every Friday at 10:30 in the morning. You're welcome to sign up. All you do is go to our website, freedmanfinancial.com. That's Freedman.
2 E's and a D.
Financial.com. And that's going to do it for us this week. That was our episode of Dollars and Cents for the week. Hope you enjoyed it all. We're going to get out of here. We'll see you again next week. Have a wonderful week, everyone.
Have a great day. Bye-bye.
During today's Dollars and Cents episode with Freedman Financial, your hosts may have discussed specific financial planning and investment ideas that are for general information only and not intended to provide specific advice or recommendations. Please remember that investing involves risk and may include loss of principal. Although the money market fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund. Always consult a certified financial planner professional, qualified attorney, or tax advisor prior to investing to determine what is appropriate for you. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC.